All right, everyone, let's get started. On behalf of the CFA Society Winnipeg, welcome to our virtual luncheon, Emerging Markets, Why Bother? My name is Zach Alderdice, and I'm a member of the Programming Committee at CFA Society Winnipeg. CFA Society Winnipeg has now served the investment community for over 70 years by promoting ethical and professional standards within the investment industry. Our society is an active participant and innovator within our international organization, the CFA Institute. We're also a member of CFA Societies Canada, which promotes advocacy efforts to our federal and provincial regulators. In addition, CFA Society Winnipeg provides our members with professional development and educational opportunities, job placement services, membership, and networking events. Today's discussion focuses on emerging markets and the long-term outlook in the space. John Ray, joining us from Baillie Gifford, will dive into this market and why he thinks the prospects for improving absolute returns look better than they have for some time. Before turning things over to John, I'll turn it over to Anthony, who will introduce us to Baillie Gifford and their unique approach to investing. A final reminder before we get started that we will have some time at the end for questions. Feel free to send them to me as you think of them via the chat bar at the bottom of your screen. Without further ado, I'll pass it over to Anthony.
Excellent. Thanks, Zach. And thanks to everyone for joining us today. I will admit today is a bit of an odd discussion, and I'll quickly tell you why. We're not here to talk about the Magnificent Seven or even the next great artificial intelligence company. We're here to talk about an asset class that's actually disappointed over the last decade, which, like I said, it's a bit of an odd topic to choose to talk about. But when you're actually digging into it, we believe that there's a great deal to be excited about. And even looking at past performance, it's a matter of perspective. So our goal today is to share that differentiated perspective, to provide you with a view into our way of seeing the world. Now, that does admittedly deserve some explanation. So I'm just going to take a step back and maybe borrow 2 minutes to provide you some background to help you understand why today may be a bit different than what you're used to. So Baillie Gifford is a 116-year-old private partnership, and that structure provides us a few advantages. One of which is that we don't have market participants breathing down our necks to meet things like quarterly metrics. We're really able to look farther out and to make investments in our business to incorporate different ways of thinking. You may ask, how do you actually do that? Well, we've built an investment team that doesn't really look like the rest of the market. So we tend not to hire people from the traditional finance background. What we're looking for are intelligent people that are genuinely curious about the world, that are excited about the prospects of exploring different paths. So when you're looking across our investment team, it's not uncommon to find someone with, for example, a medical degree, someone who studied philosophy. Using emerging markets as an example, our head of emerging markets, Will Sutcliffe, actually has a background in history. So for us, it's really about taking those different perspectives, that cognitive diversity, and really applying it to our fundamental research. So that's why we hope that today you're going to be walking around with at least one idea that might have not been there before. And to help plant that seed, I'll call him our resident gardener and emerging market specialist, John Ray. He's going to start us off by looking at why we should even bother looking at emerging markets. John?
Thanks a lot, Anthony. Yeah, I think that's a good place to start. And yeah, it's not the first time that I've had some shade thrown at emerging markets just before I start our presentation. I think it's quite warranted. And to be honest, sentiment in emerging markets couldn't be much worse. So I'm just going to share my screen just now. I'll use these slides throughout the presentation. We'll just take a second for that to come up. Okay, hopefully you can all see this now. So yeah, I mentioned sentiment there, and I think it's pretty striking that 9 in 10 global funds are actually underweight emerging markets at the moment. And whilst I'll go on later to talk about how trade is decoupling between emerging markets and developed markets. When it comes to asset prices, these are still very much driven by developed market investors. But what this does mean is that when sentiment changes, it can be pretty meaningful. And I think it's pretty interesting that if developed market or global funds move back to just a benchmark weight in emerging markets, that would see $910 billion flow back into the asset class. And it would see assets under management of the asset class increase by 58%. So in this presentation, I want to talk about, I think, why sentiment is so weak at the moment, but also some of the reasons that might drive a change. And the first place to start is returns. And as Anthony's already mentioned, they've been pretty measly. They haven't promised they haven't delivered what was promised. So let's go back to the beginning of the emerging markets asset class. What was promised? Well, in 1981, a Dutch-American analyst called Antoine van Achtmeel pitched what he called at that point in time the Third World Equity Fund to a group of leading investors in New York City. And it's fair to say that that was met with some skepticism at the time too. What he argued was that these economies offered greater economic growth and also were home to a set of often overlooked companies. Now, part of the skepticism that he received was just about the name. And in fact, Francis Finlay of JP Morgan remarked that nobody was ever going to get anywhere trying to sell a third world equity fund. So 6 years later, with a bit of marketing finesse in 87, the emerging markets asset class was born. And given the sentiment and that marketing narrative, I think you'd be forgiven for thinking that, maybe the emerging markets asset class is just a snappy bit of marketing. But actually, contrary to belief, if you go back to 87 to now, emerging markets has actually outperformed. And I'll just flick on to the next chart here. It's outperformed by about 1% per annum over the last 35 years, which again doesn't sound like a great deal, but in cumulative terms, of course, that's very, very significant. Now, I hope what this chart shows is a few different things. First of all, that it really has been a dismal decade, and there's a number of things that we could talk about here: weak commodity prices, a strong dollar, COVID, regulation in China, war in Ukraine. But actually, I think this chart boils it down to a pretty simple explanation. If we think about the global financial crisis, following that, developed markets went really on a spending spree. We had quantitative easing, and we approached zero interest rate monetary policy, which we really reached in around June 2010. And then that was maintained for the longest period that we've ever seen in history. That sent money supply through the roof in developed markets, and also developed market stocks through the roof. In contrast, emerging markets hasn't engorged itself on cheap debt, and as a result, a number of the issues that we're seeing in developed markets just aren't coming to fruition in EM. But I think another important point that this chart hopefully highlights is that the last decade isn't the only story for emerging markets, and it would have been pretty painful to have been underweight emerging markets between the periods of 87 and 94 and between 2001 and 2011. And I also think it's underappreciated that in those periods, the emerging markets index delivered over 500% per annum, which again was 5 times the return that you could get in developed markets. So I think that is underappreciated, and we need to not let our recency bias really of the next decade inform our decision making. So why is sentiment so poor? Well, one of the key worries for emerging markets investors is always macroeconomics, and I've touched on this a bit already. The Achilles heel of emerging markets over the last 40 years or so has been the linkage between US policies and emerging markets crises, with the classic playbook being that interest rates go up, capital floods out of emerging markets, economic growth stalls, and as a result, asset prices fall off a cliff. And that's why I think it's so interesting that in the last 2 years, we've been through the most aggressive Fed tightening cycle that we've seen in the last 40 years. And emerging markets on the whole has sailed through completely unscathed. As I mentioned, any issues that have been related to higher costs of capital have typically been concentrated in developed markets. So why is that? What's different this time? Well, I think the first important point to make is that capital can't flood out if no capital has gone in. And actually, we've been in a net outflow position in emerging markets since 2013. And that has had some interesting consequences. Emerging markets has had to stand on its own 2 feet, and almost on every metric, whether it's debt levels, balance of payments in surplus, inflation. And interestingly, when we look to forward-looking growth, there's not a whiff of recessions, as you can see in the far right-hand side. So I think at this stage, the natural question, well, what is putting investors off? And I think there's one of the biggest reasons has got to be the elephant in the room, geopolitics. But I would challenge the narrative that this will be bad for emerging markets on the whole. As the West seeks to grind China out of its ecosystem, we're seeing huge swathes of capital being deployed to retool supply chains, whether that's in Vietnam, in Mexico, in Indonesia, in India. But we also often forget that there are over 100 countries with over 5 billion people that are very happy to do trade with both sides of the geopolitical divide at the moment. And these countries are doubling down. And to them, it doesn't feel like the world is deglobalizing. It feels like it's globalizing. We're seeing trade between emerging market countries at all-time highs. And again, in terms of unintended consequences, I think what's really interesting is more of that trade is being done in currencies other than the dollar and other than the euro. And that presents a really attractive opportunity for emerging market economies to break that reliance on the dollar. If you think about it in simple terms, if more of your trade is being done with countries in, let's say, India or Brazil, then it makes sense to hold rupees or reais, and also to, rather than recycling those profits into UST bills or even Premier League football clubs, it makes sense to reinvest them in emerging markets because that's where the attractive return is. And I think that presents a pretty tantalizing opportunity for the next bull market for emerging markets to be not just bigger, but more self-sustaining. And then kind of looking to some more of the opportunities in EM, I really do think for all of the global challenges that we face over the next decade or so, whether that's retooling supply chains, we're going to need lots of steel and cement. We're going to need semiconductors to power the new AI era. We're going to need crucial minerals to power the energy transition. And we're going to need just lots of energy, regardless of where it comes from. And again, I think it's underrepresented that we use more energy and more fossil fuels every single year without fail so far. So this year we used more oil than we ever have in history, and that's predicted to grow until at least 2035. And I think emerging markets gets a bad reputation for its contribution to fossil fuels, its contribution to emissions. And I find this slide quite interesting. It's probably less well known that the average Canadian person uses 20 times as much oil as the average Indian person. But what we do know is that as these economies become richer, they will use more energy, and that's there are no high income, low energy economies. So that really presents challenges for global investors in a decarbonizing world. And I think that's perhaps why, despite these pretty lockstep trends over the next decade or so, when we look to oil and gas spending, it's CapEx, it's roughly 300 billion lower than it was in its peak in 2014. And similarly, when it comes to expected mineral demand for clean technologies, we're talking about multiples of increase of current levels of demand. But again, when you look at CapEx spending, it's 50% lower than it was in 2014. And even if it was higher. Particularly in the metals and mining industry, if we look at copper, for instance, it takes 17 years from an initial investment to a mine becoming operational. So I think these supply and demand imbalances really point to a decade where energy and mineral prices will be higher than they were in the last decade. And that leads us to draw lots of parallels with the emerging markets growth of the early 2000s. But I think the cynical view of that, or the natural criticism of the growth that we saw in the early 2000s, it was driven really entirely by external factors. And Will Sutcliffe, who Anthony just mentioned earlier, described investing in emerging markets in the early 2000s as a bit like looking for the best looking horse in the glue factory. And that's because it was about anticipating shifts in the cycle, perhaps an opportunity that might lift some unremarkable banks or unremarkable utilities companies from bad to less bad. And I think that's clearly changed. I think emerging markets is home to companies like TSMC, where Intel have admitted that TSMC are at least 3 years ahead of them in terms of their technological advantage. But we also have brands like BYD, like Samsung, like Nubank. And it's not just about commodity prices anymore. We have gargantuan markets that are underserved and underbanked. And I think this chart here is quite interesting. It shows the unconnected millions or even billions of people that currently don't have access to the internet. And I think we often forget about that in developed markets because we've had basically 100% internet penetration for the last decade or so, but we've got billions of people coming online. But that presents an opportunity in another vertical, in banking. Now, these sectors historically have been pretty disparate, but now if you're an individual who has never used the internet, is getting access to a smartphone, but the majority of your transactions are done in cash, so 90% of transactions in emerging markets are done in cash, that's still not going to add up. You can't use e-commerce if you're still transacting in cash. And that has presented an opportunity for the likes of Mercado Libre, who I think has really been the best executor of this in emerging markets over the last decade or so. This is a company it's an e-commerce company primarily that operates in Latin America. Latin America has one of the highest levels of internet penetration in emerging markets, but pretty poor logistics systems and a pretty unsatisfactory banking system that charges egregious fees. And that could have been a problem for Mercado Libre. There's 120 million people in Latin America that don't have access to a bank account, but they really focused on service. They invested billions in creating a world-leading logistics system, so much so that now over half of their retailers offer same-day delivery. Now, again, that might not sound that impressive to someone based in Canada or someone based in the UK, but in Latin America, that is unheard of. And if you're one of that 120 million, how do you get access to this revolutionary service? Where you open a bank account with Mercado Libre on Mercado Pago, they've got you covered. Now, that has meant that Mercado Libre has been able to grow its top line at 40% per annum over the last decade. And what I think, again, is underappreciated about that is that's been in a period where all of the economies that they have been operating in have been very, very weak. So in local terms, that's been 80% per annum, but in hard currency terms, that's been 40% per annum. And I think we're seeing these opportunities really spread out across the emerging markets universe. So this map here, I think is really interesting. We could probably have a whole presentation on this map alone. It's the world in 2050, but the map has been rescaled for population. And what I'm trying to show here is where these billions of savers, these billions of spenders are. So we've already talked about Mercado Libre. India, as we know, most populous nation in the world, and largely driven by geotelecom. The average Indian person uses their phone about 5 times as much as someone in the UK. But when we look at e-commerce, it's still so early stage, only 2 parcels per year being ordered by the average Indian person. But we've seen this in China. That was the case 10 years ago, and now it's 80 parcels per year. So there's these real upside growth stories that, again, going back to that 2000s analogy, just weren't there. Just one other point to highlight on this map, I think Southeast Asia really stands out there, and Indonesia in particular. It's less well known that that's the fourth most populous nation in the world, but it's home to 18,000 islands. So cracking e-commerce is far more important in Indonesia than it is in the UK, for instance, where we have a reasonably densely populated nation. E-commerce isn't as attractive to us because we've just got a Tesco or a Walmart down the road. So we're seeing these real leapfrogging opportunities that are offering very, very attractive financial returns. So just to kind of begin rounding this up, I hope you agree that what I wanted to show you with that map is that we have really different opportunities. South Korea, for instance, has a very densely populated nation. They have the best logistics service, and Coupang really has the best customer satisfaction of any e-commerce company in the world. We're no longer looking for the best looking horse in the glue factory, and again the numbers back this up. So on the right hand side, you'll see that the number of investable companies in emerging markets has tripled, and that's against the backdrop of actually in developed markets where they've dwindled slightly. But for us at Baillie Gifford as active growth investors, concentrated active growth investors, I think what's much more exciting is that even though the share of EM companies in the MSCI ACWI is only 11%, when you look at the share of high growth companies, almost 50% of the companies that are expected to grow their top line by more than 20% per annum over the next 3 years have their homes in emerging markets. And I think that's where the real upside for emerging markets now lies. If I was to categorize the first decade of this century, it would be a rising tide lifted all boats. If the next decade that tide went out, but it presented the opportunity for some very special companies to come to the fore. That's why we're so excited about emerging markets now, is it feels like that tide's coming back in, but we have these very, very high quality companies that will now be swimming with the tide, and that feels particularly exciting. So I'll probably stop there, and it'd be good to hear if there's any questions that have come in, Zach.
Absolutely. Yeah. Thanks, John, for the information. It was really interesting. For anyone on the call, please feel free to send a message to myself, and I will pass along the message to John. But maybe just to kick things off, let's start with a nice broad question. Are there any regions that stand out in the emerging markets world to you right now?
Yeah, I think partly what's so attractive about emerging markets right now is the different growth opportunities you can find. So Latin America is probably the most significant commodity exporter, and we do think, even if you look at the period kind of between 2004 2008, Brazil's equity market was up 800% at that point in time. Now that really was just driven by a high oil price, and Mercado Libre is a good example about how that market has expanded. But we think Latin America looks probably the most attractive region, and importantly, it's attractively valued. India's maybe on the other side. We think the macro environment for India looks very, very strong, kind of GDP growth predictions for the next decade of 6 to 7%. But from a valuation perspective, it gets a bit more challenging.
Absolutely, yes. And then how do you think the US presidential election kind of influences the emerging markets future going forward?
Yeah, I mean, I mentioned, geopolitics probably is the thing that's on people's mind the most. And whilst we've had a whole host of elections in Mexico, in India, South Africa, I do think it's the US election that will be the most impactful. But again, I think it will impact emerging markets in different ways. Mexico probably have seen it probably has the most US election risk. Mexico really has a nearshoring opportunity. And whilst Mexico is very much preparing to capitalize on that opportunity, US policy is going to be far more important. In some countries like Vietnam, I mentioned, some large regions that are positioning themselves both sides of the equation. Vietnam has had both Xi Jinping and, well, Biden visit in the last 9 months, and actually even Putin. So there are some economies that are very much positioned for kind of whatever the weather. But it will very much depend on each individual nation. Of course, China continues to be a sticking issue in US politics. It doesn't really feel like it can get much worse from here. We've seen tariffs actually come in from Canada today, so that continues to be an area we watch closely.
And maybe just on the tariffs aspect of things, how do you kind of see it changing the global thinking and the effects of globalization? Like, do you think it's a limiting factor to emerging markets going forward?
Yeah, I wouldn't say it's a limiting factor. And Anthony mentioned that Will Sutcliffe he's actually a historian from university, and he describes it as, one of the lessons from history is that if you block trade, it tends to reappear somewhere else with unintended consequences. And I think the de-dollarization trend I mentioned earlier is one of those unintended consequences. I think it's very unlikely that developed markets like Canada, like the UK, will be able to bring low-cost manufacturing skill home. So we might find that it moves around emerging markets, but I don't see it. I do think this really does present an opportunity actually for a broadening out of the emerging markets opportunity rather than a concentration. And probably the last decade has been mostly in China.
Okay, interesting. Maybe on this broadening out trend, I was just kind of curious on the Southeast Asian market, particularly kind of how you see it in the terms of development, kind of what are some markers to watch for going forward? What kind of ticks that area off? It seems like it's always coming up with Vietnam, with Apple, a number of other examples. So maybe your thoughts.
Yeah, I mean, Southeast Asia, again, it's huge generalizations going on here, but it's very well positioned in terms of supply routes. So Vietnam has been the manufacturing export gainer really of the last decade. Indonesia is home to, I think, 20% of the world's nickel, which is obviously very important for electric vehicle adoption. But this is also a very underbanked nation. So again, sticking with Indonesia, you've got companies like Bank Rakyat who operate basically a mobile banking service. And when I say mobile banking, I don't mean on your phone, I mean like a van. And that's been so important in driving banking penetration in Indonesia, because you do need to be able to travel to islands where the bank might only come once a week. So it's been really interesting, and I do think that's where e-commerce suddenly just absolutely unlocks that potential, and that's why we've actually already seen Southeast Asia has reached the highest penetration of e-commerce, and we expect that could, where we've been kind of leveling out in developed markets at about 20-25%, we could see e-commerce penetration in Southeast Asia doubling to maybe 60% from here.
Wow, okay. So I just going through some of the questions here. And then maybe just another one on kind of the whole space itself. Which segments do you think will be the driving force going forward for emerging markets? Will it be the tech revolution within emerging markets, or is it more of, will they be playing a supporting role in kind of development in the Western world as we go forward?
Yeah, I think that's what's so exciting is there's a real breadth of opportunities. There's the gargantuan markets with their homegrown opportunities that I kind of touched on with the map, but there's also the companies that are really at the picks and shovels end of driving the AI semiconductor boom. So I mentioned TSMC, Samsung, SK Hynix, MediaTek. these are all the companies that are making the chips that are going into the devices that we're using right now. And I think that's underrepresented. And you know, I know there's been a lot of volatility recently, but you're able to get a TSMC, who is the world leader in the leading edge of chips, trading on 20 times next year's earnings. That feels quite different to an Nvidia on maybe a 70 times earnings. And then there's just the hard commodities that we need, and these are in emerging markets, whether it's oil, whether it's cement, whether it's steel, whether it's iron ore, and we have seen there is a correlation between high commodity prices and strong emerging markets, and these are also things that you can't change the supply chain for hard commodities. So we do think that will drive a lot of growth, and I think the energy transition is presenting huge opportunities, both at the kind of lagging end of the energy spectrum, the fossil fuels, but also at the leading end in terms of, you know, the materials we need for batteries.
Interesting. And then maybe just a question on the logistics of actually investing in emerging markets. Do you see it? Obviously, there are risks with governments in those regions. They can be volatile and a little bit less stable than some of the more Western countries. Do you see a better way to play that market as investing in Western companies that have exposure to those countries, or are you comfortable doing direct investments within the countries themselves? And then how do you evaluate the ability to get your money back at the end of an investment?
Yeah, no, that's a very fair question. I think particularly in China, for instance, the best way to play China over the last decade or so was actually to own Western brands that, when GDP per capita increased, that capital then flowed out for the kind of the aspiration of those Western brands. We're really seeing that change. You know, we are seeing, you know, world leading. If you look at the car industry, we're seeing huge disruption in the car industry. You know, biggest luxury purchase usually is a car. In 20 years' time, maybe it's not a German brand that people are looking for. Maybe it's a Chinese brand like a NIO, for instance, which has been really rapidly growing in China. And I think probably the one place that we would like to see more change would be actually in commodities. The majority of the strong commodity companies do tend to be developed listed, and we're quite happy to play that as long as the majority of the revenues and assets are in emerging markets. But I think the risk that you have is missing out on the economic growth that comes with you know, high commodity prices. For instance, if you're just owning a developed developed listed commodity miner, you're going to miss out on what the impact for Mercado Libre is. You know, I mentioned that it's grown its revenues at 40% per annum. If it's no longer dealing with a headwind for its earnings, but actually a tailwind, then you'll miss out on the really wide opportunities. And again, I would point to kind of that chart at the very beginning. I do think it's underappreciated, the scale of what those opportunities and also the longevity of them.
Perfect. Well, if anyone has any last questions, feel free to send them in now. Otherwise, I'll give people a minute and we can start wrapping up. Perfect. Well, I guess we'll call it there for today. Thanks for all the information, John. It was really insightful and it's very much appreciated. Thank you also, Anthony, for joining us. We hope to see you guys again soon. As an expression of our appreciation, the CFA Society Winnipeg will be making a donation on Bailey Gifford's half to Harvest Manitoba. Thank you, as always, to Ava Swan for helping set this event up. And thank you, everyone, for joining us today. Hope to see you at future events and have a great rest of your week.
Thank you very much.